Looking to make some extra cash without breaking the bank? With just a small investment of $25 per week, you can start your journey to earning over $5,000 a month. Yes, you heard that right, it's possible. In this video, I'll share simple and practical tips that savvy investors keep secret. I'll introduce you to the DRIP strategy and show you how to enhance it. By the end, you'll see how this strategy can turn a $25 per week investment into a portfolio worth over $500,000, generating over $5,000 in monthly dividends. So, grab your $25 and let's embark on the path to financial success. Every successful plan needs a strategy, and investing is no different. Our goal is to retire comfortably while still receiving regular income, as if we never left our jobs. But with only $25 a week to spare, the DRIP Dividend Reinvestment Plan strategy is our best bet. DRIP is a smart way to grow your investments over time, like planting a seed and watching it grow into a mighty tree. Instead of using soil and water, you use your dividends to buy more shares, which then generate more dividends, creating a cycle of growth. Here's how it works. Imagine you own shares in a company that pays dividends. Instead of taking those dividends as cash, you reinvest them to buy more shares. This means you own more shares, which in turn generate even more dividends. It's like a snowball rolling down a hill, getting bigger with each revolution. One key benefit of DRIP is compound interest. When you reinvest your dividends, you buy more shares. When those shares pay dividends, you reinvest them as well, leading to exponential growth over time. For example, suppose a stock is worth $20 per share and you own 100 shares. It pays a $1 dividend per share each year. At the end of year one, you'll have $100 in dividends. Instead of cashing out, you reinvest and buy 5 more shares of the stock. Now you have 105 shares. The next year, you'll get $105 in dividends, and so on. Each year, your dividends increase, and your investment grows thanks to compound interest. Another benefit of DRIP is dollar cost averaging. Instead of trying to time the market, you buy shares regularly, regardless of market conditions. This helps to smooth out the highs and lows, averaging out the cost per share over time. For example, if you invest $100 every month in a company's DRIP, some months the share price might be high, so you buy fewer shares. Other months, the price might be low, so you buy more shares. Over time, your average cost per share balances out, reducing the impact of market fluctuations. DRIP also offers the convenience of automatic investment. Once set up with your broker, everything is taken care of for you. No need to manually reinvest dividends or time your purchases. It's a streamlined process that helps you stay focused on your long-term goals. By now, you might be wondering how to make the most of the DRIP strategy. Here's how you can supercharge it by contributing a set amount every week, month, or year. In this example, I'm investing $25 per week into my portfolio. That's $100 per month or $1,200 per year. Let's break down how this can make a significant impact on your investment journey. Firstly, increasing my contribution to $25 per week accelerates the pace at which I buy more shares. With more money going into my portfolio regularly, I can purchase additional shares more frequently, benefiting from compounding at a faster rate. Each new share generates dividends sooner, boosting growth. Secondly, adding money every week takes better advantage of dollar cost averaging. By spreading out purchases over time, I buy shares when prices are both high and low, reducing the impact of price swings. Investing $25 each week is simple and fits into my budget easily. And with DRIP, I don't have to worry about remembering to invest, it's done automatically. Now, when building a successful DRIP strategy, choosing the right stocks is key. By selecting stocks that meet specific criteria, you can maximize long-term returns. I look into these 4 categories: blue-chip dividend stocks, dividend aristocrats, high-yield dividend stocks, and growth-oriented dividend stocks. Here's why these categories matter. 1. Blue-chip dividend stocks. These reputable companies have a long history of consistent dividend payments, indicating financial stability. Examples include Coca-Cola, Johnson & Johnson, and Procter & Gamble. They provide a solid foundation for long-term growth. 2. Dividend aristocrats. These companies have increased their dividends for at least 25 consecutive years, showcasing a strong commitment to returning value to shareholders. Examples include AT&T, ExxonMobil, and Walmart. They stabilize your investment strategy over time. 3. High-yield dividend stocks. These stocks have higher than average dividend yields, making them attractive for income-focused investors. Examples include Realty Income Corporation, AbbVie Incorporated, and Verizon Communications. While they may carry more risk, they are an important part of the portfolio. 4. Growth-oriented dividend stocks. These companies offer capital appreciation and dividend income with strong growth prospects. Examples include Microsoft, Apple, and Visa. Based on these criteria, I've selected the following 5 stocks to boost my portfolio: NextEra Energy, Starbucks, Abbott Laboratories, Home Depot, and the ProShares S&P 500 Dividend Aristocrats ETF. Here's a snapshot of their current metrics. NextEra Energy, 2.76% dividend yield, 10.98% dividend growth rate, 11.98% annual share price appreciation. Starbucks, 3.01% dividend yield, 16.69% dividend growth rate. Abbott Laboratories, 2.1% dividend yield, 11.4% dividend growth rate, 10.31% annual share price appreciation. Home Depot, 2.59% dividend yield, 17.91% dividend growth rate, 16% annual share price appreciation. ProShares S&P 500 Dividend Aristocrats ETF, 2.04% dividend yield, 20.48% dividend growth rate, 8.17% annual share price appreciation. Combining these into a portfolio, the metrics might look like this. Current dividend yield, 2.5%. Dividend growth rate, 15.49%. Annual share price appreciation, 10.87%. Now, can this portfolio generate enough for you to retire? Let's find out. If John invests $25 every week into this portfolio, amounting to $100 per month, or $1,200 per year, his investment strategy would unfold like this. At the end of the first year, his weekly contributions are projected to reach $2,560. After 10 years, the same investment with weekly contributions and dividend reinvestment is projected to grow to $27,825. After 20 years, it's estimated to reach $145,500. After 30 years, John's initial investment has the potential to soar to $823,000. Alongside this impressive capital appreciation, he'll receive $63,900 in dividends every year, translating to approximately $5,280 every month. In total, this portfolio has the potential to add $786,500 to his investment, with $464,500 coming from reinvested dividends. And that's it for today's video. If you liked this video, please give it a thumbs up, share it with your friends, and subscribe to my channel for more videos like this. And don't forget to leave a comment below and let me know what you think about this video or any other money-related topics that you want me to cover in the future. Thank you for watching, and I'll see you in the next one. Bye.